In 2019, a dozen eggs cost you about $1.50. Today, they cost $3, maybe $4, depending on where you live. And here's the thing everyone keeps getting wrong about that. They're never going back to $1.50. Not next year, not in 5 years, probably not in your lifetime. The government will tell you this is a victory. Economists will call it success. The news will celebrate it as a return to normal. But your grocery bill will still be double what it was. Your rent will still be higher. That car you've been eyeing will still cost $10,000 more than it did before the pandemic. Because there's a word most people don't understand. A concept that gets thrown around in financial news like everyone knows what it means, but almost nobody actually does. Disinflation. Not deflation. Disinflation. And the difference between those two words is the difference between prices going back down and prices just rising slower. The difference between getting relief and getting told you should be grateful things aren't getting worse as fast. This is the story of why your money doesn't go as far as it used to, why it never will again, and why almost everyone in power is perfectly fine with that.
Let's start with what actually happened. March 2020. The world shuts down. Millions of people stop working, stop spending, stop moving. The economy doesn't slow down, it flatlines. Businesses close, supply chains collapse. The stock market loses a third of its value in 3 weeks. So, the government does what governments do in a crisis. They flood the system with money. Stimulus checks, paycheck protection programs, enhanced unemployment. The Federal Reserve drops interest rates to 0 and starts buying bonds like there's no tomorrow. Within months, trillions of dollars get pumped into an economy that's barely functioning. And at first, it works. Markets stabilize, people pay their rent, businesses survive. But then something else happens. People have money, lots of it, more than they've had in years, and they're stuck at home with nothing to spend it on except stuff. So they buy stuff. Everything. Furniture, electronics, home gym equipment, groceries in bulk, anything they can order online. Demand explodes, but supply can't keep up because half the factories are shut down. Shipping containers are stuck in the wrong ports, and there aren't enough truck drivers to move anything anyway. And that's when prices start to move. At first, it's small, a few percentage points here and there. The Fed says it's transitory, just a temporary spike while things get back to normal, nothing to worry about. Then 2021 arrives. The economy reopens. People want to travel, eat out, go places, do things. They still have money to burn. Demand keeps climbing. Supply is still broken. Inflation hits 3%, then 4%, then 5%. By 2022, it's at 7%, then 8%. By summer, it peaks at 9.1%, the highest rate in 40 years. Your eggs that cost $1.50 in 2019 now cost $3. Gas hits $5 a gallon in some states. Rent jumps 20, 30, 40% in major cities. Used cars cost more than new cars used to cost. Everything is more expensive, and everyone is angry. So, the Federal Reserve does the only thing it knows how to do. It raises interest rates, aggressively, from 0 to over 5% in less than 2 years, the fastest hiking cycle in modern history. The logic is simple. Make borrowing expensive and people will spend less. Make spending less and demand drops. Drop demand and prices stop rising. And it works. Sort of. By late 2023, inflation falls to 4%, then 3%. By 2024, it's hovering around 2.5%, close enough to the Fed's target of 2% that people start talking about victory laps. Headlines announce inflation is cooling, prices are stabilizing, the economy is achieving a soft landing. And this is where the lie happens. Not an explicit lie, just a very convenient misunderstanding that nobody in power bothers to correct. Because when they say inflation is cooling, what they mean is prices are rising slower, not that prices are falling, not that your eggs are going back to $1.50. They mean your eggs went from $3 to $3.05 instead of $3.50.
You're still paying double. You're just paying double at a slower rate of increase. This is disinflation, the slowing of inflation, not the reversal of it. And here's the part that makes people furious once they understand it. This is considered a success. So let's talk about what deflation actually is, because this is the thing everyone thinks they want, but almost nobody actually does. Deflation is when prices go down, not slowly, actually down. Your $3 eggs go back to $2, then $1.50. Your rent drops. Your car costs less. Everything gets cheaper. Sounds great, right? Your money goes further. You can buy more with less. The American dream is affordable again. Except deflation is an economic nightmare. Here's why. Imagine you're thinking about buying a car. It costs $30,000 today, but you've heard prices are dropping, so you wait a month. Now it costs $29,000, so you wait another month, $28,000. Why would you ever buy the car if you know it'll be cheaper if you just wait? You wouldn't. Nobody would. So consumer spending collapses. People stop buying anything they don't absolutely need right now. Businesses see sales drop. They cut prices further to try to move inventory, but that just makes people wait even longer for prices to fall more. Companies start laying off workers because nobody's buying anything. Unemployment rises. People have even less money to spend. Demand drops further. Prices fall harder. This is called a deflationary spiral, and it's very, very difficult to escape once it starts. Japan tried for 30 years after their asset bubble burst in the early 90s. Negative interest rates, massive government spending. Nothing worked for decades. Prices stayed flat or fell. The economy barely grew. An entire generation came to age in stagnation. The Great Depression was a deflationary spiral. Prices fell 25% between 1929 and 1933. Sounds good until you realize unemployment hit 25% too. Banks failed, businesses closed, people lost everything. So central banks around the world learned a lesson. Deflation is worse than inflation, much worse. Their job isn't to make prices go down, it's to make sure prices keep going up, just slowly enough that people don't riot. The Federal Reserve has a target, 2% inflation per year, not zero, not negative, 2%. That means prices are supposed to double roughly every 36 years. A dollar today should be worth 50 cents in 3.5 decades. This is by design. This is the plan. This is what success looks like. And when inflation spikes to 9%, their job isn't to reverse it, it's to get it back down to 2%, to get prices rising at the acceptable rate again. Which brings us back to disinflation. Let's walk through the actual numbers, because this is where the disconnect happens, where people feel betrayed by the statistics. Let's say you're spending $100 a week on groceries in 2019. That's your baseline. Inflation runs at about 2% for years, normal, barely noticeable. By early 2020, you're spending about $102. Fine. Then the pandemic hits. Inflation spikes. Over the next 3 years, cumulative inflation runs at about 20% on many consumer goods. Some categories more, some less, but let's use 20% as a round number. Now your groceries cost $120 a week. Then inflation cools. Disinflation happens. Inflation drops from 9% back down to 3%. Everyone celebrates. But here's what that actually means for you. Year 1 after disinflation, your $120 grocery bill rises 3%. Now it's $123.60. Year 2, another 3% on top of that, $127.30. Year 3, $131.12. Even if inflation magically hits the Fed's 2% target and stays there forever, in 10 years you're spending about $146 on those same groceries. Your wages might keep up. They might not. Historically, wages lag inflation, especially for lower and middle-income workers. But the point is this: You never get back to $100. The price level never resets, it just keeps climbing, hopefully at a rate that doesn't destroy the economy. This is the math nobody explains clearly. This is why people hear inflation is under control and think, great, prices will go back to normal, and then feel gaslit when they don't. The government isn't lying exactly. They're just using technical definitions that mean something very different from what normal people think they mean. When a politician says they're fighting to lower costs, what they mean is they're fighting to lower the rate of increase of costs, not the costs themselves. When the Fed says they've tamed inflation, they mean they've stopped it from accelerating further, not that they've reversed the damage already done. And when economists declare victory, they mean the crisis has been contained, not that anyone's life has gotten more affordable.
Now, here's where it gets interesting, because there's a whole ecosystem of people who benefit from this confusion. Politicians love to take credit for disinflation. They'll point to a chart showing inflation dropping from 9% to 3% and say, look what we did, we brought prices down. Except they didn't bring prices down. They brought the rate of price increases down, which is good, important even, but it's not the same thing. And most voters don't know the difference, so the politician gets to campaign on fighting inflation while everyone's grocery bill is still 40% higher than it was 4 years ago. Financial media does the same thing. You'll see headlines like, "Good news for consumers, inflation cools to lowest level in 2 years." And technically that's true, the rate of inflation is lower, but the average person reading that headline thinks it means things are getting cheaper. They don't. Even the language is designed to obscure. Cooling inflation, moderating price pressures, easing cost growth. All of these phrases sound like prices are coming down. None of them mean prices are coming down. This isn't a conspiracy, it's just the way technical economic language gets translated into public communication, but the effect is the same, mass confusion about what's actually happening. Meanwhile, corporations are quietly thriving. See, when inflation spikes, companies raise prices. They have to, in many cases, because their costs are going up too. Supply chains are expensive, labor is expensive. Everything costs more. But something funny happens. Once they've raised prices and people have accepted the new normal, those prices tend to stick, even when the company's costs start coming back down. There's a term for this: greedflation. The idea that companies use inflation as cover to raise prices more than necessary, padding their profit margins. Is this happening everywhere? No. Is it happening somewhere? Almost certainly. Look at corporate profit margins during the recent inflation spike. Many companies reported record profits, not just revenue, profits, which suggests they weren't just passing along costs, they were taking advantage of a moment when consumers expected prices to rise. This is rational business behavior. If everyone expects inflation, you raise prices. If your competitors raise prices, you raise prices. If consumers don't revolt, the new price becomes the floor. And when inflation cools, you don't lower prices back down. You just stop raising them as fast. Maybe you run a sale here and there, but the baseline stays elevated. So companies lock in higher price levels, workers get modest raises that don't quite keep up, and the wealth gap quietly widens. All while the government declares victory over inflation. Here's the part that should actually worry you. The entire modern economy is built on the assumption that prices will keep rising forever, slowly, steadily, about 2% a year. If that assumption breaks, everything breaks. Think about debt. The U.S. government owes about $35 trillion right now. That sounds insane, and it is, but it's also manageable under one specific condition: inflation. If prices rise 2% a year, then in real terms, that debt becomes less burdensome over time. The dollars used to pay it back are worth less than the dollars that were borrowed. This is how governments inflate their way out of debt, not by paying it off, by making it smaller relative to the size of the economy.
But if deflation hits, that equation reverses. The debt becomes more expensive in real terms. Tax revenue falls because prices are falling. The debt-to-GDP ratio explodes. Same thing happens to homeowners. You take out a 30-year mortgage assuming your income will rise over time with inflation. Even if your salary stays flat in nominal terms, inflation erodes the real burden of your monthly payment. But if deflation hits, your income might fall while your debt stays the same. Suddenly, your mortgage is crushing. This is why central banks are terrified of deflation. It's not just an economic problem, it's an existential threat to the entire financial system as currently constructed. So they'll do everything in their power to prevent it, which means they'll tolerate inflation. They'll accept higher prices. They'll call disinflation a win and move on, and regular people just have to live with the consequences. But here's the darker possibility nobody wants to talk about. What if they can't control it next time? The tools the Fed used to fight inflation this time were standard: raise interest rates, tighten monetary policy, let the economy slow down without tipping into recession. It worked. Barely, but it worked. But those tools have limits. Interest rates can only go so high before they break something: the housing market, the stock market, the banking system. We got a preview of this in March 2023 when several regional banks collapsed after the Fed hiked rates too fast. And inflation can come back. Supply shocks, energy crises, geopolitical disruptions, climate disasters, any of these could send prices spiraling again. If inflation spikes to 15%, can the Fed raise rates to 18% without destroying the economy? Probably not. So what happens then? Maybe we get stuck in a world of persistent high inflation, where 5 or 6 or 7% becomes the new normal, where your money loses half its value every decade instead of every 36 years. Or maybe we overcorrect. The Fed hikes too hard, something breaks, and we spiral into the deflationary trap everyone's been trying to avoid. Either scenario is ugly. And both scenarios result in the same outcome for most people: less purchasing power, less economic security, less ability to plan for the future. So here's where we are. Inflation spiked, the system responded, inflation came back down, the crisis was averted. But prices didn't reset. They won't reset. The new normal is just the old abnormal with a different label. Your eggs cost $3. They're probably going to cost $3.20 in a couple years, then $3.40, then $3.60. This is success. This is the plan. This is what stability looks like in a world designed around perpetual inflation. And the question nobody seems to be asking is this: how long can this go on? How many times can we spike inflation, cool it down, and lock in higher prices before people stop believing the system works for them? How many more once-in-a-generation crises can we have before the tools we use to fix them stop working? How much wealth can transfer from workers to asset owners before something fundamental breaks? Because here's the thing about disinflation that nobody mentions: it's not a solution, it's a holding pattern. It buys time. It prevents collapse. It keeps the machine running. But it doesn't fix anything. It doesn't make life more affordable. It doesn't reverse the damage. It just slows down the rate at which things get worse. And eventually, slowing down isn't enough. Eventually, people notice that the language of victory doesn't match the reality of their bank accounts, that the statistics showing improvement don't align with the experience of trying to afford rent and groceries and gas on a salary that hasn't kept pace. Eventually, the gap between what the experts say and what people feel becomes too wide to ignore. We're not there yet. Maybe we never get there. Maybe disinflation is enough. Maybe 2% inflation forever is sustainable. Maybe the system holds. But if it doesn't, the next crisis won't be about the rate of price increases. It'll be about whether prices mean anything at all anymore, whether money means anything, whether any of this was ever built to last. Your eggs cost $3. They're never going back to $1.50, and the people who designed it this way think that's just fine. The question is, do you?